I'm Keith McCullough, and welcome back. I had a little sandwich there. I just said to Dan Holland that maybe Jersey Mike's is going to start sponsoring this thing. I wolfed that thing down. Hopefully I can survive the next 45 minutes with a top-end analyst that I've been waiting for a long time to have this discussion. I know it's not your first time on Hedgeye TV. You had a good conversation with my colleague and now partner, Rob Simone, who got made partner at Hedgeye in the last year. But he spoke highly of you. The Twitterverse loves you. So Lyn Alden, welcome and thanks for making some time.
Thanks for having me. Happy to have a conversation.
So I want to take I like to give people an opportunity to get to know who you are and know about your process. I did find it unique that you started on your own in terms of going out of the corporate world or whatever you might call it at the same age as I. At 33, I started Hedgeye. You ostensibly started Lyn Alden Investment Strategy. So can you give people a little bit of history in terms of your background and how you got there?
Sure. So my background actually started in engineering. I did electrical engineering and then engineering management in the aviation industry, focusing on building and maintaining and running aircraft simulators for research purposes. That was kind of what I focused on, and started out as design engineer, but then shifted mainly to managing the finances of the facility. And people often ask how I got into investing, and the funny thing is, it's actually before I went into engineering, I was interested in investing from a very young age, but I pivoted towards engineering. And if anything, I kind of eventually came back towards investing. That was kind of always my passion all along. And so what I try to do kind of at the end of the day is apply an engineering mindset to investing. I treat things as systems analysis, systems engineering. And so I take that kind of quantitative focus. And so, I look at mainly the longer term, right? Like the 3 to 5 year investing horizon. What are the major trends? What are the tailwinds going to be over that period most likely? But then I temper that by looking at things like, what is the kind of the 18-month cyclical cycle look like? It's probably it's a less detailed version of what you would call the quads, basically the kind of the rate of change of what's happening in business. And I overlay that onto these longer term trends that I try to look at. I take into account, long term it's about valuation and fundamentals, but obviously short term it's more about liquidity sentiment, various price movements, the kind of the ongoing cycle that we experience. That's how I try to approach things.
And you also, you have an acute focus on just boiling it down in English, which I think is pretty cool. I try it myself. My problem is I keep making up my own words and whatnot, so then I start to confuse people with trade, trend, tail, multi-duration, multi-factor. But and actually, that's one thing I definitely want to get into now that you say it that way, because my multi-duration model, like my trades, trends, and tails, are actually at their max inside of your, where you start, because you're 3 to 5 years and my long-term tail is always 3 years or less, and I'm always looking at the 3-week to 3-month, cyclical to trading relationship. But that's what makes for really good conversations, is when people, Neil Howe, for example, on our demography side, he's more like on the 20 to 30 year, spectrum. So that's really helpful. But first, before we get into that, can you just expand on that part of your mission, if it is your mission, if I read it correctly?
Yeah, definitely. I've generally found that there's a unmet market for kind of sophisticated retail or plain English institutional research. And so, if you look at the landscape, until maybe recently, you have institutional research, which can be very complicated, very jargony, kind of difficult to access. A lot of the investment research dedicated towards retail tends to be sensationalist, generally low quality. And so one of my approaches was to basically take institutional research and put it into plain English. And the funny thing is, institutional people appreciate that too. So it's not just taking institutional and giving it to retail. It's taking institutional and then just covering it in plain English, so that both relatively sophisticated retail investors can make use of it, hopefully, and then institutional researchers, they find certain angles differently, especially if you have a fresh lens. Like my lens is through that engineering perspective. It's kind of a different way of looking at things compared to what they might find, other people write in that field. And you mentioned Neil Howe. I actually found his research very useful as well. One of the things I try to incorporate, because I found it to be very useful in this environment, is that super long-term perspective, even though it's generally past an investment horizon. But the way I treat that is looking for things that deviate from the normal cycle. right?
Hmm.
So when you have these kind of like larger, what he would call a fourth turning, these larger events, I find that very useful, and I've kind of actually combined that with Ray Dalio's research on the long-term debt cycle.
Hmm.
About 5 years ago, I was trying to get my mind around where this kind of macro environment was headed in kind of the generational sense, right? I was kind of asking big questions like what happens when this debt gets to unsustainable levels? How is this resolved? And I saw Ray Dalio's research, and he pointed back in history, and I ended up doing a deep dive in that whole period. The last time we had, sovereign debt levels this high in the developed world, and so I kind of also have those multiple different time frames. It's just that my average time frame is obviously further out than your average time frame.
Yeah, it's fascinating to kind of hear how somebody approaches the same thing in a different way, but in a way it's the same way. Like I mean, there isn't a view that I have on a trade trend tail basis that isn't wrapped around the all-time cycle view, right? There's no such thing as looking at, which I want to get into with you, the CNI lending cycle or the current state of banks within that cycle without pulling it back. Like Bob Schiller taught me how to do that. It was actually the first thing in plain English for an idiot from Thunder Bay, Ontario to go to Yale University to understand in the economics. That was the first thing I understood. I mean, I was like, I'm not going to fly a rocket ship to the moon, and I'm certainly not going to be the top student in this calculus class, but I can understand mean reversion. And to do that, you actually have to look at the all-time term in the time series. And it really is helpful to have a demographic view because that's one of the few things, as you well know, time, space, and life itself, that really isn't subject to a lot of opinion.
Yeah.
Have you found anything else like that? Because I'd love to find like 10 Neil Howes. I know they don't exist, but in different realms that have their own body of work. Are there other people out there that you would recommend that I have on Hedgeye TV that are super long cycle types that I could access?
Yeah, that's a challenging question, I think, off the top of my head. But basically, for me, the two kind of points that I found useful is combining some of that Ray Dalio long-term debt cycle with Neil Howe. It's almost like you get the quantitative view
Yeah.
and then the qualitative view kind of put together. I think Luke Roman covers, some of that long-term stuff very well. Also, kind of these big pivotal events. And I generally find that there's no one analyst that I follow for any one thing, but I kind of piece together what I think people are strong at, and then try to find someone else that covers what they might be weak at, including my own weaknesses. For example, I don't cover anything in the healthcare sector really. I can't differentiate, different types of healthcare companies, so I have to look out at people that I think cover that better than I do. I might have a macro view of that space. I might have a valuation view of that space, but I don't have any knowledge on pharmaceuticals. And the same thing is true for when I cover geopolitics or these kind of bigger things, where for me, I take a very quantitative approach. I like to go to the raw data, but then I combine that with other people that help me interpret it.
Yeah, I mean, the struggle when you're narrative driven on a longer term basis, just because you write about long term doesn't mean that it's helpful. And I'm not going to go off on certain people that do that. But I mean, I really do think that you have to bring it back to what's happening in the market, what's happening in the rate of change data, et cetera, et cetera. So let's do that on this banking crisis. And I know you've written about it, but maybe take your first crack at summarizing like today's quote unquote banking crisis versus '08. Do you think they're similar in any regard? Do you think they're quite different?
Yeah, the main difference is that this is more of a duration challenge compared to a credit challenge. So back in 2008, going into that event, you had basically generationally low cash and safe assets on bank balance sheets relative to their riskier things like loans, things that can actually default. And obviously, they did run into a default event, so they risked their whole bank capital getting wiped out by these series of defaults. And it looked in many ways very similar to the 1929 crisis in terms of, say, the how much bank loans were outstanding relative to the monetary base. These kind of like these big generational charts in the quantitative data. And so that whole the 2008 crisis and the 2010s aftermath were in many ways very similar to the 1929 crash and the whole 1930s aftermath, which is, going back to Neil Howe, that's, basically the fourth turning type of environment. This one's different in the sense that it's at least so far, there are certain pockets of credit risk. But the main thing hitting banks is that ironically they invested in very safe assets, but at wrong prices. And now they're facing their deposit rates going up, they're facing unrealized losses, and then they have a challenge where obviously they can hold those assets to maturity, but the market doesn't always let them do that, especially if they have deposit runs and things like that. So earlier, last month there was a liquidity crisis. Now I think it's evolving more towards a profitability problem because, while the Fed and others have these facilities in to prevent ongoing liquidity, or at least reduce the severity of some of these ongoing liquidity problems, banks now face an issue where, they have some of these long duration assets that might be relatively safe, and many of them are, but then they have rising deposit costs overlaid on top of that. And if you look at the Federal Reserve's own balance sheet, I mean, they're in the red. They're operating at a loss now because their liability is adjusted upward very quickly. That's a policy they decided to do, and essentially we're seeing the slow motion version of that happen to the commercial banking sector, where their deposit side is slowly kind of catching up with a big lag compared to where the Fed's own rates are. And you see that more so happening in the long end of the medium and smaller banks, whereas larger banks have more overall position to not really raise rates as quickly because everybody wants an account at those bigger banks. And so right now there's a kind of, I think, an ongoing profitability problem among those small and medium-sized banks. And then it's obviously further exacerbated by some areas of actual credit concern, things like autos, things like commercial real estate that are well-known issues at this point.
Well, the tie-in, or I should say that, it's really the tie-in and the handoff. I mean, when you go from just outright duration mismatch to, okay, now we have a liquidity issue from a corporate cash flow perspective, and you're still my credit line, and you're still having this duration mismatch. Now, I've just tried to boil it down. Jamie Dimon got all the money, but his clients still have a credit problem.
Yeah.
The credit problem's born out of the credit cycle, which is born out of the cash flow cycle or the cycle itself. So what do you think about that handoff?
I think it's going to be a mess. And I think one of the, going back in history again, looking at, say, the 1940s, which is the kind of the closest macro environment, oddly enough, to the 2020s environment, that was the last time they tried to come off the zero bound. When they were on the zero bound, they had inflation, and they tried to raise rates off that zero bound. And the question is, how do they handle it? And the answer was an absolute mess. They basically had to, they did yield curve control, they inflated away a lot of debt, and then they tried to slowly come out of that zero yield environment back to getting back towards positive real yields, and it took them quite a long time. And that was an environment with partial capital controls. That was an environment of no social media. Things happen slower, so you get people into these silos, and you can slowly change things. I mean, gold was banned for 40 years for Americans. It was kind of a weird environment, and essentially in this now we're in a fourth turning again, and essentially they're doing this. They're in a same environment where they're obviously trying to get off the zero bound in a very indebted environment. This time, I think the challenge they're running into is they actually took a different course in the playbook. Last time they did basically what Japan's doing now, the yield curve control, raise things slowly. This time they tried to rip the Band-Aid off and just jack rates up. And basically it's emanating into the banking problem, and it emanates into real estate. And I think we see these cascading problems. And I think the challenge is that they eventually face kind of a Minsky moment where they're not able to handle both at the same time, where they basically are in a situation where they try to normalize rates, but that they still have to end up providing liquidity to the treasury market and some of these other kind of core markets. And I think they're going to be in that kind of weird environment again, with the key difference being that we are in a different technological environment now, where we have social media, we have rapid real-time data, we have more free flow of capital, at least for the Western world. And I think that's the challenge they run into, is that they're essentially applying a 1970s kind of inflation fighting playbook to a situation that's actually more like the 1940s. And I think it will result in some pretty extreme outcomes.
Yeah, and that's the biggest problem with people that come up with a narrative that tries to make it, this is like '08, or this is like '01, or this is like the 1940s. I mean, it's always different all the time, but the cycle itself has the rhythm and rhyme, to it in terms of trying to find its bottom. very good point that you made on like when you think about duration mismatch at the regional bank level. On this slide 96, which you alluded to this, but just to put some meat on the bone, like when we think about the like 8 trillion in like low yielding fixed rate securities against funding the 8 trillion in higher costs, this is really interesting. I mean, if you just like to put it, what I really like about this conversation and your mission here is let's put it in English, all right? So is it fair to say that the Federal Reserve has become the world's largest regional bank, with a duration mismatch problem?
Essentially, yeah. I wrote an article about that months ago.
Oh, you did?
I wrote an article about that months ago because that chart that you posted, was floating around. And I dove into it because what that chart,
mine was floating around.
That St. Louis Fed chart, one with the one you just showed, the remittances.
Yeah, exactly. Yeah.
And basically the problem with that chart, because it shows the problem, but so all those numbers prior to that going negative are weekly numbers. It's how much basically the Fed is sending to the Treasury every week, and then they change their calculation in the end there, and it becomes cumulative.
Yes.
And it kind of damages the chart. So I saw that Jim Bianco, he put out a really good chart that he made the whole thing cumulative. He took that data set and made it cumulative, and it shows that you basically have this line going up for like 10 years, and it starts to roll over. I made a chart where I was inspired by his work, and I made one that was both cumulative, and then I also showed the weekly ones on it as well. And I dove in an article about why this is happening to the Fed, what choices led to this. And that was a few months ago. And essentially, it's what you pointed out, that was almost a precursor for what we're seeing now in the regional banks. That the Fed has huge unrealized losses. They have. Unlike most banks, they actually have an operating loss, meaning that their liabilities are yielding higher than their assets, which is historically very unusual. Now, unlike a normal bank, they don't have to necessarily make a profit, but over time, it does start to impact a number of things. One is it impacts the Treasury because the Treasury used to get a revenue source out of the Fed. Now they don't get that revenue source anymore. And then longer term, if this goes on long enough and they dig themselves in a deep enough hole, it actually does kind of bring up questions around central bank independence, because kind of central bank solvency is kind of one of the factors that at least leads them to have some degree of central bank independence compared to what you get in kind of a banana republic where there's really no independence at all. So over time, if you were to have them hold that level for a sufficiently long period of time, and you have commercial banks have to slowly raise their deposit rates in order to compete with money markets and T-bills, you'd eventually have them all start to look like that sheet, essentially. They'd all start to have these kind of negative profitability, and they would start to eat into their capital. And so I think that they're going to have pretty insane decisions ahead of them, where sometimes they're facing both inflation and recession problems at the same time, or at least kind of back to back. And it's the worst possible environment for a central bank to navigate, because if they have a 1970s style problem with low debt and high inflation, the answer is to tighten. Whereas if you have the combination of very, very high debt levels and inflation, that's when they face kind of the impossible scenario.
It's really interesting when you take that, and very well put. You take the simplicity of the math that the Fed used to generate positive P&L and hand it to Janet Yellen. This is the real simple way to think about it. And now they're losing money, so it's not about losing money, because they can't actually lose money. They just can't give Janet any more money. So this is, how do you think about that? I've thought about this, obviously, but how do you think about that with the T minus 6 weeks on the debt ceiling?
Well, so the TGA is already getting pretty low, the Treasury General Account. Yeah. And so basically what the way this all works is they've already started taking extraordinary measures. It's like if you'd lost your income source and you can't, tap in your credit cards, you have to start drawing down your existing cash balances in order to pay your liabilities. And so that's what Yellen's doing right now. They're supposedly going to get an increase, in these next couple of weeks due to tax season. That's possibly overstated due to how poor most capital gains were over the past year. So we'll see the magnitude of that. The debt ceiling issue might strike more quickly than Yellen has previously estimated. I'm sure there are a lot of people doing really deep research on that. But I think essentially that is a huge catalyst to be aware of, because ironically, it's not necessarily the debt ceiling to focus on. It's what happens right after it. When they resolve that debt ceiling, and the Treasury tries to raise their cash balance back to their normal target level, that's a huge liquidity withdrawal
Yep.
out of the financial system that is already very tight on liquidity. So, autumn of last year basically was kind of a partial turning point in liquidity because for most of last year, you had the Fed drawing down their balance sheet, and that was obviously pulling a lot of liquidity out of the market. But then starting in the later part of the year, you had the Treasury really begin to offset that to a significant degree. They were pushing liquidity back into the market while the Fed was pulling it out. And so you actually had somewhat neutral liquidity conditions overall, kind of this choppy sideways kind of stagnant liquidity environment. And if you get to the end of that where the Fed is still trying to draw down and now the Treasury is trying to refill its account later this year, that's a double negative whammy for liquidity, and it might cause one or both of them to have to course correct. But the path between there and here and there, I think, is going to be fraught with volatility.
Yeah, the one of the most important charts that people can constantly refresh on that front is net liquidity. Stan Druckenmiller actually taught me that. I mean, we learn a lot from other people, and it's nice to have somebody on Hedgeye TV that acknowledges the places that you learn things. I learn things from people all the time. But just measuring and mapping net liquidity when you get the double negatives, that's really bad. But just to finish this and then bring it back to the banks itself, so we have the world's largest regional bank with a duration mismatch problem,
Yep.
and instead of having a company that they can't give a credit line to, they have a country. So, it's, to me, just looking back to, there's seasonal patterns to markets, but it's kind of bullshit unless you understand like which one you're already in. But the timing when you have, like as Mandelbrot would say, like particular things at particular points in cycle time, there's a particular endpoint where the money, like where the government cannot fund itself. And like you said, depending on tax receipts, we'll see what that date is. But it's not like it's in August. It's sometime in June, and it might be late May. So we've defined the point in cycle time where the most risk is. And we also have, like at least according to me, the lowest point of real GDP growth, lowest point of inflation, lowest points of corporate profits in that same window of cycle time. If you go back to April of 2011, between April of 2011 and August, the S&P 500 was down 20%. I mean, what do you think about that last point, just fully loaded with the cycle point in time, and agree or disagree with it? And the inability of this damn S&P 500 to even give you a sneak preview that it wants to do something like that.
Yeah, I am very cautious on equities for the next several months. I think that there are attractive areas longer term, but until we have more clarity on this liquidity situation, we see basically a storm on the horizon. It's unclear how they're going to handle it. Now, if the market correctly sniffs out to say the Fed's going to blink and they're going to pivot their liquidity, kind of like they already partially did in March, it's possible the market, say, front runs that, and then it never gets the big sell-off that some of the bears expect. On the other hand, and that's part of why this is a challenging market, because it's so human-driven. We're basically trying to predict what a handful of individuals like Yellen and Powell are going to do. So there's a couple ways they can handle that. One is that obviously if they reach very low cash levels, they can shut down the government for a period of time to extend the period that they can operate without an outright default on some of the more either essential payments or the debt itself. So they can extend it with that a little bit, but that obviously has an economic impact on its own right. And then essentially when they eventually have the debt ceiling impasse, one or two things has to happen. Either the Federal Reserve might have to provide more liquidity, which is awkward given their current inflation mandate, or the Treasury, for example, can shorten their average duration of Treasury issuances and try to draw liquidity out of the reverse repo market. But that also, it doesn't make sense from a number of standpoints. That's the most expensive part of the curve right now, and it also deviates from their normal kind of plan of maintaining rather consistent average durations. So I think that's going to be a big challenge for them, and it's just this multi-month period of we see decelerating profit margins, we see decelerating growth, we see across the spectrum. If you look at all these different parts of the economy, we see labor starting to weaken to varying degrees, even though that's traditionally a lagging or coincident indicator compared to some of the others. Even that one is beginning to show somewhat fairly early signs of weakness now. And I think a lot of recession indicators are kind of pointing towards that same part of the year, as you pointed out, with the liquidity crisis. And I think that cash, T-bills, cash equivalents, not, relatively low volatile stocks are ways to maybe weather the storm until we have greater clarity on how they're going to handle these kind of extreme environments.
Yeah, that's I like the weather analogy because the weather is undeniable when you're in it. And if you have a forecast, God forbid it's accurate, yeah, you might be prepared with the umbrella. So only on Wall Street would somebody come up, Lyn, with another answer to that, which is, well, due to the valuation today, I'm not going to use the umbrella. It's just that's why I never start with valuation. But if we go to slide 95, I just want to doodle on something for you. I did it with Liz Ann, and apparently, according to the audience, they like that. So I'll do it one more time. At the risk of being repetitive, I won't use the same chart. But so this is, as you'll well recall, going back to 2011. Debt ceiling showdown, as I pointed out. From point to point, this is a 20% drop in the S&P 500. The black line is the S&P 500. But all the way up until April, it's like, I'm willing to believe. Then you get a little bit more of a chop, and then you just get bang all at once. On the other side, on the other axis, we of course we have the CDS. What do you think? I mean, so I'm just making a point here, Lyn, of history that. History would tell you can have a train oncoming in front of your entire family, and Wall Street will keep the kids right there on the train tracks until the train is there, making a variety of arguments as to why the train should stop. Until the train actually gets there, and then you have, in this case, that's exactly what happened, right to the wire, kaboom, it all went down at the same time. But never has American CDS not been the front end, tip of the spear, leading indicator on the front of every. Back then, I mean, it was on CNN, for God's sakes, every single day. I mean, it was on, when it gets to CNN, something that would be on CNBC, you know that other people are paying attention. So what do you think about that? Like when you wake up in the morning and you go through your process, you look at your indicators, can you talk about what you see when you see the US CDS chart where it currently is and where it's come from?
Yeah, so what I've been tracking over the past several months is this, especially this liquidity environment. And basically the whole thing was it's like ironically because the debt ceiling and they have to draw down their cash balance, it's actually been constructive for liquidity. Yes. in recent months. And that was something for months now I've been writing about, saying that ironically this is a type of environment where some of this bad stuff can actually be surprisingly decent for the market. And that's, I think, part of why the S&P 500 has been holding up pretty well. And so you have this environment where it does not look good. I mean, it looks good for a period of time until you get to that point where it actually hits the road, right? Mm-hmm. When you actually run out of the TGA, when you actually get to either the government shutdown or the impasse, and then the need to refill it. And so I think that explains a big chunk of why the equity market is ignoring the CDS, is ignoring some of the other, kind of indicators we're having. The same thing actually happened going into the COVID crash. Basically, you had, commodities started to smell it out. You had basically a number of analysts point out that this, the virus is actually serious. It's actually going to spread. You had a lot of fundamental research kind of pointing in a direction, and the equity market, it just didn't price it in at all. Week after week after week, it was not pricing in at all, and then it was all priced in at once. Yep. And so I maybe a less extreme version, more like the chart you showed. I think that's something to be wary of later this spring or early this summer. Exactly when it hits, we'll see. But essentially that. The ongoing liquidity is still decent at this time, but it points towards a liquidity train wreck going forward. It's a very, it's very appropriate summary. I mean, slide 61, we just call it the sinkhole, right? I mean, the last thing, of course, to cave in is the surface. And, in the equity market, if you take out 7 stocks, the equity market's not the same equity market. It looks more like the Russell 2000. So that, of course, is also giving you plenty of sinkhole analogs that you could kind of roll with. But the last thing I wanted to ask questions on before I take other people's questions, if you have questions for Lyn, just pop them in the queue and I'll ask them. Taking this to a place where, I'm not a bull. I have been bullish. It's not like I'm some kind of perma bear or anything like that. But how do people that are bullish on Bitcoin, take everything that you said and say that's bullish for Bitcoin? Well, I think partially you define your time frames first of all. And so basically some people, what they do is they they put Bitcoin in a different segment where they say this is something I'm not going to touch for a certain period of time. Kind of like how if you have physical gold in your house versus say a paper gold in your portfolio, you
Yep.
might treat them differently. You might say that the physical gold, I'm not going to worry about the price. I'm not going to worry about timing anything. Whereas the paper gold, I might, try to do that.
Yep.
I think this is the same for Bitcoin. I think there's, if you define yourself as a Bitcoin trader, you want to focus heavily on things like liquidity. I've done a lot of work on trying to figure out what are the main factors that are the strongest correlation with Bitcoin price. So, historically, one of the ones is the halving, but that's actually not really good for a specific timing purpose. Generally, liquidity and economic indicators are better. So, if you put it simply, if you buy Bitcoin when the PMI is rising, you're going to have a better time than if you buy Bitcoin when the PMI is falling. And if you want to get more precise than that, if you look at various liquidity indicators, they generally front run PMI a little bit.
Yep.
And Bitcoin also tends to front run PMI a little bit. So actually the closest correlate that I've generally found for Bitcoin is various measures of liquidity, both domestic liquidity and then global liquidity, including, say, dollar-denominated global M2 in rate of change terms. Those are the types of things that correlate heavily with Bitcoin. And so in any sort of like near-term environment, if you're trying to judge what it's going to do in a multi-week or multi-month period, you have to generally have a decent view on what liquidity is going to do. Whereas long-term, you can look at things like, what percentage of the supply is liquid versus like tightly held. What are the developments happening on that whole ecosystem? So what is making Bitcoin better to use, better to interact with? What are the other technologies kind of building on that whole stack? And so the way that I view Bitcoin is I have this kind of long-term holding, this very long-term structural view that I occasionally check to make sure that thesis is still in place. But then I use the shorter term stuff, the cyclical stuff, to one, manage position sizes, and then two, set expectations in a near term. And so, for example, I would use during this past cycle, I would use GBTC as a way to, get in or get out, kind of change my position in that sense. Whereas, like, say, cold storage Bitcoin, I treat more like physical gold, where it's something that you have a structural view on that you almost hold as a separate, like a separate category.
Yeah, I think, well, I'm almost certain that that's why you and Rob Simone had your first conversation at Hedgeye TV, because he thinks of that physical gold analogy in his Bitcoin mining and how he thinks about adding to it and subtracting to it, which he subtracts from it as well. Some people think you just DCA something and it's just like rainbows and puppy dogs. That's bullshit. I mean, I don't know. I mean, dollar cost averaging is what Wall Street's tried to tell you to do with mutual funds since the beginning of time. But how somebody functionally does it that owns it like Rob does, he does think of it as his physical asset, and trading it is different. So I appreciate that, and I get it. The liquidity component, it makes me think back, kind of like, first of all, to the last 30 minutes of our conversation, which is liquidity on a net basis was actually, if you called for what you called it, which was actually accommodative on the margin up until the most recent period, where it became very accommodative. I mean, if you guys go to, I think it's slide 65 on our deck. I mean, you just what's eliminating 63% of QT in 2 weeks? I mean, obviously, everything like that. It wasn't just Bitcoin, but those two things, Lyn, have been, I'd say, in the aggregate, looking backwards, of course. And I'm different, to be clear, because I'm cycle to date guy. So I go from backtesting any asset class against the quads. The only quad you have to worry about being long Bitcoin or crypto, is, if you think of it as an asset class, is quad 4. Quad 4 started to get priced in starting at basically the middle part of November of 2021. And I just stay with my full investing cycle and trade the moves in and around it. But if I take your perspective and I just say it's all, like, liquidity is the number, and correct me if I'm wrong, I mean, you're starting with the liquidity first, I start with my quads, right? And by the way, they kind of sleep together a little bit. So, the PMIs aren't accelerating in quad 4, they're decelerating. But what do you think about that? Could that explain how Bitcoin has had its rally? And if we're going into net liquidity being unaccommodative, and you don't get any more cowbell eliminating that, on that order of QT, that becomes a headwind?
I think that's absolutely a factor. And like I said before, when I was doing research to figure out what is most correlated with Bitcoin, I kind of touched on multiple areas. Like one
Right.
is that economic rate of change, like, PMI, or, a set of indicators that kind of resemble something like PMI. Is the economy accelerating or decelerating? That is a pretty strong,
Yeah.
and the reason those both work is that both liquidity and the quads or the economic cycle are rather correlated in themselves, because liquidity is kind of a big component that helps drive economic cycles one way or another. And so you kind of get a slight difference on the exact timing. But yeah, essentially, I do think that this recent liquidity pump was a big factor. Now, obviously, Bitcoin has been rising before you got this big March liquidity injection,
Mhm.
which is obviously it's different than QE, but it's still a pro liquidity effect while it was happening. And so, I think part of it was that, you know, Bitcoin was so beaten down by the whole, crypto fraud, FTX, all that stuff that happened last year. So if anything, it was earlier this year, you had kind of had a partial recovery just because you had super oversold levels. You had a lot of kind of long-term people kind of coming into the market, buying it, pulling it back up. A lot of it also was the dollar index. So, if you look at where the dollar peaked back at that
Yep.
late last year, that was roughly when you started to have domestic liquidity trend sideways. I talked about it earlier. You had the
Yep.
Treasury was providing liquidity that the Fed was still removing, and so if anything, that kind of is partially explains the Bitcoin move, because you had, liquidity was getting worse and worse and worse, and you had all these leverage things blow up. But then once you had that kind of liquidity start to stagnate for a period of time, it allowed the fundamental kind of longer term aspects of Bitcoin to start taking over again. But yeah, if you have liquidity roll over again here, I do think you could have Bitcoin consolidate or correct for a period of time, rather than keep going up at the same pace it has been, year to date. I think we're already kind of maybe seeing early signs of that, where we're due for a pause, due for a correction, and I think that'll be heavily tied to partially the economic cycle, partially liquidity, and then especially because both of those are inherently intertwined anyway.
Yeah, I think it's a stealth call out, and you've done it twice, and I had you repeat it. Again, people don't really understand the subtleties of that net liquidity being a benefit. And when you came off a very deeply oversold level on our signal, as I'd call it, and it wasn't just that; it was a lot of things. But cool. All right, I'm going to ask some of the questions that are in the queue, if you don't mind, and
Sure.
one has to do with, I know you do have. Correct me if I'm wrong, but you have a view that, like, banks actually teasing you or raising these deposit rates is a risk to the banks. Is that right?
Well, longer if they raise their deposit rates at a very quick rate while they still are not able to adjust their asset side very quickly, then it
Yep.
eats into their profitability.
Yeah.
And then they have to do things like either reduce share repurchases, eliminate share repurchases, slow down their dividend growth, maybe cut their dividends in more significant extents, or outright have to raise capital. And so I do think that some of these long tail banks have profitability challenges as long as the Fed tries to maintain rates where they are, and that slowly starts pulling up the deposit rate towards those levels.
Yes, that's well put. One of the world's best performing hedge fund managers this morning literally texted me that. He said he's because WAL. I don't know if you saw what they did. Did you see what that company
I
did?
I did not.
So it's one of these banks that got absolutely jacked. But he's like, Wall's only up because they're giving away the farm, 4.5% deposit rates, no shit. But this means their NIM's going to get hammered going forward, et cetera, et cetera. I mean, it is and this is, I'm leading to this first, to the top voted question, which is the others. And again, I really appreciate that you bring it back to what, common people without all the nomenclature can understand. I think people can understand that Apple's teasing you with a 4.15% deposit rate on Apple Pay now. I think you can understand that if you're a bank, you got an account at WAL, or you could flow money there, that 4.5 is a good number. But does everyone, essentially, the first question from Bill is, how safe is that money, and should you be doing that in your personal account?
Well, so I think when you have your cash, you have to find what the purpose is. Obviously, if you're looking for the longer term safer stuff, T-bills, money markets that have reverse repo exposure to the Fed. I mean, you're getting better counterparties than any individual bank. Whereas banks are more for that liquidity that when you need it right there. And historically, when you look at the prior hiking cycles, generally you wouldn't get much average deposit rate changes, even as the Fed was hiking, partially because they wouldn't stay there for a very long period of time. Banks generally have pretty high switching costs. People don't shop around too readily with their existing accounts when you have kind of a hiking cycle. But if they do stay higher for longer, I am, concerned about a number of these banks, and like I said, I haven't looked too deeply into that one yet. That's a fairly new announcement,
Yeah.
but generally, I would be concerned about any sort of teaser rate because you have to ask long term, is this sustainable? I mean, a lot of these banks are holding securities and loans that are yielding, less than or roughly in line with that 4% number. And so it does kind of threaten their long-term profitability in order to have very, very high, um, those super high rates. And I think that, we don't see much movement on, for example, JP Morgan, because they don't have to raise rates. Everybody wants an account at JP Morgan, but you do see kind of these long tail of other banks being the ones that are more aggressive in trying to retain or collect deposits by jacking up their rates, and that does threaten their profitability.
Yeah. So put simply, I would say that I wouldn't put more than 250 grand at Wall Bank.
Yeah.
WAL is the ticker. I don't even know what the bank's called. But there are a lot of banks. Yeah. That's why I don't know all their names. They're just banks. And if somebody's offering me that, and I put $1, actually, and now you got to monitor it because you do put it at 250 and you compound, at 4.5, you're gonna have more than 250. So I mean, this is going to get really interesting for America, right? Because I don't know what Liz Warren's going to think about that, but if you're a Wall and all of a sudden you get a bunch of people put in 250 and the thing goes belly up, then what the fuck?
I think we're probably going to see consolidations on that long tail of smaller banks because in addition to being more readily having to raise their deposit rates to keep up with this sort of thing, they also have a larger percentage of their assets are loans than securities. So they're less liquid overall. They're less able to use, the Fed's new facility. And, we've had already this multi-decade consolidation of fewer and fewer absolute number of banks, even as the overall banking sector has grown because you've had that consolidation, the acquisition. And I think that to some extent that's going to accelerate that some of these banks that run into problems get brought into the larger ones. And I'd be very cautious on keeping anything above the FDIC limit in any bank, especially banks outside of the top four, because you never know, you never know where these things can strike, especially because if a bank's, even if it's relatively, solvent on the surface, you don't know necessarily the quality of its loan book unless you've done rigorous analysis on that particular bank. And so any one of these is kind of subject to risks. And I think it's going to be just an ongoing challenge because now that product's out, for example, that's another liquidity suck. So money markets are already kind of, pulling capital towards them. The large banks are already pulling, deposits towards them. Teaser rates like this can pull deposits towards them, and that puts a lot of pressure on the existing banks that are have very low yields on their asset book and are slowly having to raise rates to keep up with this.
Yeah, it's just going to be just a mess. I mean, it's a mess. All right, last question, and it's from one of your fans. I told you you're going to have a whole bunch of them on the queue, and it is cool to have you on Hedgeye TV. If I haven't said that multiple times, I'll say it again. But from Paul Clayton, hi Lyn, great to see you on Hedgeye. I see a lot on the Bitcoin crypto YouTube channels being interviewed. How much of a crypto bubble mania head trip do you think we still have left?
So I separate kind of Bitcoin from the rest of the crypto space. I think that the broad crypto space, I think the noise to signal ratio is unfortunately very high. I still think there's a lot of froth that has to bleed out. I think we're obviously seeing more and more regulatory hits against that space. Basically, is they define what is a security, which assets have violated security laws, which companies have violated security laws by selling those assets to the public, and so I think that whole space is kind of fraught with landmines going forward. I'd be very cautious around putting serious capital in that space. Bitcoin I put in a different category because it's not a security. It's recognized as a digital commodity because it doesn't pass the Howey test. I also think the fundamentals that the actual decentralization is more robust, and so I do think that a lot of the froth has already been worked out of the Bitcoin space. A lot of the tourists have gone during this whole kind of catastrophic bear market. There's a lot of interesting development that's happening, both in terms of you can get exposure with the underlying asset, but then also for credit investors, there's actually interesting, say, VC opportunities out there that I think quite good. But once you go to the broader space, I still think there's a lot that's probably going to bleed out over time in terms of existing froth across the market.
That's a very good answer, a concise one at that. And very good conversation. I mean, my favorite people in this profession are people, again, it's not the old wall people because they haven't evolved. I mean, to be an engineer and essentially, and hopefully you don't take offense to this, I call you like a polymath, who can really think about the entirety of the system within your own framework. I mean, that's hard to do because you have to have your own framework. And two, it takes a shitload of work and constantly refreshing. And you weren't afraid to say, hey, look, I didn't look at that bank yet. That's new news. I'll look at it. I think that's a pretty critical thing as well. But, for us, because at least it was for me. And by the way, if anyone has wants to dig in deeper on why Lyn and Rob Simone think that way about Bitcoin differently than the rest of crypto, I believe we have that up on YouTube, so you can go watch that conversation. But man, great, like a really good job. And in terms of going from A to B from 2016 to where you're at now. And now I know why you have a lot of people following you. So thanks for joining us today.
I appreciate that. Thanks for having me on. And I do think that one thing I appreciate about a Hedgeye is that kind of defining your different time frames for examining things. I often find that a lot of analysis out there, one of the mistakes they make is they only focus on one time frame. And obviously we can't all cover every time frame, but by having a set of different time frames that you cover and knowing how to differentiate them, I think is that kind of settles a lot of the confusion out there when you see people talking past each other or people with different views. It's making sure you have a clearly defined time frame for the specific action that you're referring to.
Yeah, the time in the cycle that you come into something, the time that you take a position, the time by which you look at things, it's critical. It's actually, I'd say if you don't have that, then no one should listen to you at all. So now a lot more people are going to listen to you. And again, thanks for making the time.
Thank you.
Lyn Alden, nice find by Dan Holland for the Hedgeye Investing Summit. Up next, I'm going to be psychoanalyzed by Dr. Geo.